Hello and welcome to our mid-year outlook. My name is Richard Dunbar, Head of Multi-Asset Research, and I'm delighted to be joined by Jeremy Lawson, our Head of the Aberdeen Research Institute and our Chief Economist. You join us at a difficult time for the global economy, a difficult time geopolitically, and hence a difficult time for markets. Most asset classes are down year to date, some by quite a lot, and even within some of the bright spots such as commodities, some of these areas are also down year to date. It's been the third worst start to the year on record for the S&P, with many fixed income markets little better. But this is all looking in the rear view mirror. So what's happening on the road ahead of us? What do we think? Why do we think it? And why does this matter to the asset classes in which we are invested? And so to try and start answering these questions, firstly, over to Jeremy to try and answer the macro question.
Recessions. How likely are they over the next 1 to 2 years? Unfortunately, we think that they're much more likely than not, particularly in the major advanced economies. To understand why, you actually have to go back all the way to the period after the global financial crisis. The period after the crisis was one in which nearly every major central bank struggled to reach its inflation targets. Inflation was far too low and policy was too tight on average. When the pandemic hit, most policymakers were frightened that exactly the same thing would happen, and they were so focused on boosting demand, supporting households and businesses to get through the pandemic, avoiding the mistakes of the post-GFC period, that they stimulated more aggressively than they had in decades. Simultaneously, they lost sight of the way in which the pandemic was likely to and eventually did severely disrupt the supply side of the global economy in many different ways. Energy markets, supply chains, labor markets, none of them have returned to the type of conditions that we saw before the pandemic. And so policy settings that were put in place to support demand and quickly return inflation to target ended up dramatically overstimulating the global economy. And so now most economies are operating well above their capacity. Inflation is very high, not just headline rates, not just because energy and food price inflation is high, but across the board. And where the consensus that existed during last year that a lot of this inflation would prove transitory has evaporated very quickly, and central banks have quickly got the message that they have to act quickly and aggressively to rein in inflation. Unfortunately, when imbalances are as large as they are today, right, when underlying inflation is very high and labor markets are extremely tight, demand has to be destroyed one way or another to bring inflation under control. So in our view, and our clear base case, is that there will be recessions across the major economies within the next 2 years. How soon? Well, in some countries, these risks are probably already materializing. In the Eurozone, which is at the epicenter of the shocks caused by the war in Ukraine, the energy price shock and the food price shock is proving particularly acute. And going into the northern winter, it's sort of very likely that we're going to be sort of seeing constraints on the ability to even use energy, right? So shortages that dramatically affect output. And so Europe is probably the major economy that goes into recession first. It may take a little bit longer in the United States and some other advanced economies. For example, we saw in the most recent employment report in the United States, labor demand remains sort of rudely healthy. But ultimately, that's going to require, particularly again with inflation being so high, even tighter policy settings from the Fed and other central banks. So recessions in 2023, more likely than not. Of course, there will be important differences across the global economy. So for all the imbalances that exist in the advanced economies and some key emerging economies as well, China sort of stands out as being on a very different footing. There was never the type of aggressive stimulus put in place. The COVID policies that have been in place for a long time to effectively maintain zero COVID, even whilst nearly every other economy in the world has abandoned it, have kept demand very subdued. It's actually still an economy where arguably there's too much supply, too much production, chasing too little demand. And so underlying inflation is very subdued. this is allowing the authorities to loosen policy at the same time as policy is being tightened nearly everywhere else. So you could almost sort of think about the United States and China like they're ships passing in the night, just as the US economy is going to have to decelerate quite aggressively under the pain of the policy tightening and the restrictions on disposable incomes. The Chinese economy, which has been very weak over the last 12 months, is likely to be picking up speed. Not boom times, not enough to rescue the global economy, but certainly a very different outlook. Now, I've characterized what we see as our base case here, but always we need to keep in mind in the ways that we might be wrong. There are very many different scenarios for how the future might unfold. Two particularly important ones. One on the positive side is the idea that, well, actually, maybe we're so caught up in the mistakes, the forecasting errors we've made over the last 12 months, particularly around inflation and supply chains, that we miss improvements in the global supply side over the next 12 months. So inflation could come down more quickly. We've already seen many commodity prices sort of declining from their recent peaks. There are indications that supply chains are improving. Maybe wage growth starts to moderate with only a modest degree of monetary policy tightening. In those circumstances, a soft landing might be possible. And that, of course, and Richard will talk about this later on, would be much more positive for markets than our base case would be. Other sort of scenarios where we might be wrong, sort of involve sort of things that actually in the long term are probably going to be pretty bad. So, for example, we could get a sort of a further stagflationary shock, another energy price shock even above what we've already seen, which makes the inflation problem worse. But perhaps central banks don't react very strongly to that initially. So the global economy, the global expansion continues for some time. It doesn't go into recession as quickly as we expect, and maybe actually even acts as a gateway to permanently higher inflation. That would be very bad for assets in the longer term if central banks didn't do the job that they really need to do, but it would definitely generate different market dynamics than in our base case.
So Jeremy notes an environment with few historic parallels, real policy rates so low, an economy at full employment, and inflation way above target. So what is priced in? What does that environment tell us about asset prices today? Bond markets have been quicker to price the changing views of the Federal Reserve and other central banks. Perhaps less so the interest rate cuts that might follow the recession that Jeremy noted in our central case. Equity markets are down a lot, but bond yields are up a lot and risk premia are also up a lot. Perhaps what's not been reflected in the fall in equity markets is the impact of the recession on profits, cash flows, and therefore dividends. The earnings season that we approach will be watched very closely to see what the underlying effect of the changing global economy is having on corporate cash flows, and probably as importantly, what chief executives and chief financial officers are saying about the outlook. The last earnings season was a strong one. This one would perhaps be less so, but the outlook statements will be looked at closely. And as I say, we feel that the potential risks to earnings are not reflected in many equity markets. In real estate, like equity, a more benign outcome is certainly being priced by many markets. Care is merited in these markets, and stock selection will be important, with a particular focus perhaps on residential and logistics as being areas that can weather these storms better than most. As regards currencies, at the start of the year, we favoured the dollar for a number of reasons. Firstly, we saw it as offering value at the time. We didn't think it reflected the likely path of monetary policy from the Federal Reserve, and it was seen by investors as a safer haven in a more difficult macro and geopolitical environment. We still favour the dollar as we sit here today, but perhaps less valuation opportunity within it, a greater appreciation by investors of the path of monetary policy by the Federal Reserve, and it certainly still has a place as a diversifier in the portfolio, but perhaps less so than at the start of the year. Within equity and bond markets, we have an equity within that underweight equity stance. We prefer to express that through an underweight in developed market equity. We're seeing some valuation protection in some areas of the emerging markets, particularly Asian emerging markets, which I'll come to in a moment. and favouring that Asia-China based on valuation principally, and that relative macro attractiveness that Jeremy noted earlier. Bonds, as I said, are pricing the environment we're noting a little better, and we are looking to add to government bond positions in the portfolios. In terms of credit, lending to companies, we think care is merited, and we'd prefer to be lending to higher quality credits at the moment, so preferring investment grade credit over high yield credit. Pulling this together, portfolio construction as ever, but particularly perhaps more so at the moment, is going to be important, particularly with reference to some of Jeremy's upside scenarios. Firstly, when one looks at fund manager surveys, some of the biggest worries amongst fund managers are hawkish central banks, global recession and inflation. In essence, what we've been talking about today. Additionally, as Jeremy noted, around that cautious central case are more optimistic alternative cases, whether that be the Fed managed to thread the needle, supply side recovery, or perhaps a savings rundown from individuals or corporates. So we believe we should be setting up our portfolios for that cautious central case, but also ensuring some exposure to things that would benefit from the rosier outcomes that might come if that central case is wrong, as Jeremy noted earlier. Jeremy, have you anything to add from a market perspective?
Thanks, Richard. I think maybe the one thing that I would point out is that although markets have, over the last few months, come to grips with how steep the policy tightening path is likely to be, I don't think they've come to grips with the full consequences of that policy tightening, which is why what's implied in bond markets is only still a pretty mild reduction in interest rates once we get to the peak. So that's another way of saying actually the bond market, like other markets, isn't pricing recession risk at the moment, or isn't pricing in the likelihood that we expect. So indeed, if the Fed does overshoot and other central banks overshoot, if there is a recession and it has any depth to it, it's not impossible that policy rates could get all the way back down to the zero lower bound, and 10-year yields are definitely not priced for that eventuality.
That's all we have time for. A tricky first half and undoubtedly a cautious outlook, but not all negative, with pockets of value emerging, as we noted. Jeremy and I have been doing this long enough to know that the clouds will eventually clear, and in due course we will see the sun. But in the meantime, enjoy the rest of the summer, and Jeremy and I look forward to seeing you for the next outlook at the end of the year. Thank you.